Okay, fantastic. Investor Circle, lovely to have you here, Ollie. Thank you so much for making time today. I think we met originally through Robert Scribe, right? So it's nice to bring you now into the Investor Circle thing. Do you want to introduce yourself and of course, Fuel Ventures? How does it work?
Yeah, absolutely. Thanks, Stuart. So I'm Ollie. I'm one of two partners for the seed fund at Fuel Ventures. Fuel Ventures is a pre-seed and seed fund focused on UK, specifically SEIS and EIS qualifying businesses, and we do that through two separate vehicles. So we have our pre-seed fund, which is 30 to 40 deals a year. It's 250k max tickets, highly diversified at the very earliest stages. Now, I don't work on that fund personally, although obviously I'm very heavily connected to the people that do. We have a team very specifically that works on that side of the business. We then have our seed fund, which is really the core fund that we initially built Fuel Ventures on, which is the fund that I represent. We'll do £1 to £2.5 million tickets at seed. As generally the lead investor, we don't have to be a lead, but generally we will come as a lead, and we will only invest into EIS qualified businesses, doing about 10 to 12 deals a year. So much less than the pre-seed fund, but still pretty well diversified, and that's a really core part of our thesis. We want to make sure that diversification is significant. That goes into our investment remit as well in terms of sector. We're pretty generalist. So our official investment remit is that we look at marketplaces, platforms, and SaaS model businesses, both B2B and B2C, which is broad and is purposely broad for that diversification piece. We want to make sure we're not pigeonholed too hard at the start. We want to make sure that we can look at loads of different opportunities and consider. We have about 75 companies in our seed fund. We have about 125, 130 in our pre-seed fund. So we're a very active investor. Those are all investments we've made since 2016. We were founded in 2014 by a guy called Mark Pearson. Mark was the founder of a company called myvouchercodes.com, which was an online marketplace of vouchers and experiences, very similar to what sort of Groupon brought to the market later. He sold that business in 2014. He was also a very active angel private investor as well. Had a decent sized portfolio of which he put decent money into. Had some really good success from that. Once Mark sold My Voucher Codes, he decided to set up Fuel Ventures just because of his experience working with founders in his own portfolio, people that he'd actually brought into his own offices to support. And decided that's the route that he wants to go down. Mark's an investor in our funds, so has a very strong personal interest, but he's also our CEO, MD, does all the work we'd expect that person to do on a full-time basis. So he's a full-time member of the team as well.
Amazing. So how many people in the team now at Fuel?
That's a good question. I think so across everything, I think we've got about 21 people. We've got 3 on the EIS side specifically, we've got 3 on the SEIS side specifically. We've got obviously some support staff as well that we help basically all the important things that we need to do as an investor. And we've got a fundraising team that includes fundraising for our own funds. We're an SEIS and EIS fund, so we continuously fundraise. We don't do a sort of GPL style fund. To raise more money from larger investors, Series A.
So, Ollie, do you run that as a series of closed funds every year, or do you run that as an evergreen fund that you're constantly fundraising into?
We run it as an evergreen fund, although technically I can't call it an evergreen fund because we don't recycle funds. And I think a core part of an evergreen fund is that it's recycled, which ours is not. As soon as we get returns for our investors, we distribute them to investors. So we don't have that process in. But in terms of fundraising, it looks very similar to an evergreen fund. We have a single pot of money that we continuously raise money into. We will then deploy those pots into a certain number of deals post their investment to make sure that they've got a sufficient number of diversified deals. That's how we'll do it. But we won't do secondary investments or tertiary investments from that any investment that we do in the third time.
So for first-time founders that are watching this, how would you position Fuel, say, compared to SFC or Hatch? Where do you fit in that kind of spectrum?
Yeah, so obviously I have good relationships with the guys at SFC and Hatch. Have respect for both of them and worked with both of them. We're slightly different just in terms of stage and size. fees. So with our seed fund, Hatch deploys SEIS, deploys SEIS. So it's quite competitive in terms of what we'll do. And frankly, if you've got a term sheet from all three, it really comes down to personal preference, who you want to work with, who do you think the right people are for you. What questions are you asking? So one question you might ask for us, and maybe something that works in our favour, is about future investment, because we've got quite a significant seed fund and we've got a pre-seed fund. Well, actually, if you do well and you're representing our pre-seed fund, we can actually quite easily come in with our seed fund with a quite significant lead ticket for your next round, and that saves you a lot.
And it's a big signal to somebody else looking in as well. If you've been part of the pre-seed and then you don't actually put it into the seed, they're kind of wondering what you think about everybody.
Absolutely. And there's loads of there's reasons that we won that are legitimately not necessarily to do with what we think about the company or the growth of the company. But you're right, and people want to know if we're following on and things like that. And the fact that we've got the ability to is quite significant. Where Hatch and SFC sit is just on the slightly smaller ticket side. They'll come in earlier than our core seed fund, but they'll come in with smaller tickets. So our average ticket size is about I'm taking a bit of a guess there just based on my experience, but I think I'm probably right in that. Because they're investing at that slightly earlier stage. But like I said, when we're thinking about the competitiveness of it, there is a little bit of competition at that pre-seed stage. But actually, at seed stage, we'll work with the guys there, because, like I said, we've got a good working relationship with them and a lot of respect for them. So we're very, very happy to be alongside them.
Obviously, all SEIS funds work in their own way. One of the things that a few founders have mentioned to me is with Jensen and SSE, take I'll call it a commission on the money that's deployed when it comes out of the fund. So it's usually somewhere in the 5 to 10% range. Is that something that Fuel does, or is that something more like Hatch?
It's something that we do. So we do it that way round. We do so for our SEIS fund, it's a 5% fee. The reason that we do it that way, as opposed to doing it the Hatch way, is this is a really interesting internal conversation, Stuart, that you're hitting on quite early. Because for me as an investor, I would obviously rather that we took from the investor side. That for me, because I can talk to companies and I can say no fees on you and things like that. If you're raising money, you want to take it from the investment side, because ultimately it's more convenient for the investor. The investor comes to you and says, I'm an SEIS investor. I want to invest 100k with you guys into your SEIS fund, or I'm an EIS investor and I want to give you guys £500,000. But what does that mean in terms of what I'm actually deploying? Well, if we're taking fees from the investor side, actually what that means is that they're not getting EIS on £500,000 worth of investment. They might only be getting EIS on 95% of £500,000 worth of investment, and that's something that they've got to factor into their taxes and things like that. So we've always worked on the basis that actually it's by being more convenient to the investor and by charging fees on the company side, two things can happen. One, we can make the fee super simple. So when we put a term sheet forward and when we do have fees attached to it, we just say it's a flat fee. We don't have, I think some people they've got a mentoring fee on a yearly basis, or they might call it a director seat fee on a yearly basis, or they might call it, we don't do any of that. We have a flat fee at the point of investment, covered, done, off the table, no longer on your balance sheet, as it were. The second thing is we can bring significant tickets. And actually, by the way that we've structured the fund in terms of being slightly more beneficial to investors, yes, okay, we have to charge a fee at the point of investment, which, like I said, for me is also quite annoying. But what it does mean is that I can bring a significant ticket. My average seed fund ticket is 1.6 million, right? Very, very few EIS funds. In fact, I don't know really any EIS funds on the market that can bring that size of ticket at seed. The reason I can do that is because we've got the ability to fundraise quite aggressively, and people are willing to put significant sums of money behind us. it might be annoying if I have to charge a fee at the end of it, but at the same time, what I can prevent is you as a company having to herd the cats, which is, you know, okay, great, I'm not charging a fee, and but I can only give you 500 grand, and you've got to go out and find another 1.5 million, and I can't give you the money until you found the other 1.5 million, and then you have to make sure that everyone's in line and everyone's happy with the documentation and everyone's happy with and then you got to herd the cats. I don't have to do that. I can sometimes give you a full round. I can give you from 40 down, and probably a couple of follow-on investors that can just fill out the round for you. Just tell you
And that's time, right? That's valuable time and valuable cognitive cycles that you don't have to spend on. Yeah.
Absolutely. So yeah, that's how I would validate it to a company, even though I will happily admit that sometimes it's a bit more. But I do think there is a validation there.
All right, Oli, in quick fire, top 3 criteria for your investments. You've mentioned diversification. You know, where does team fit? What are the 3 things that you're absolutely going straight at as soon as you get that deck and you're scratching and sniffing at it?
Yeah, so the first thing that we'll always go for, team is always the first thing, which I imagine, Stuart, especially for you, who's done quite a lot of these interviews, is completely unsurprising. And I imagine even the people that are maybe raising their first time rounds are pretty unsurprising to them too.
But everybody has a different view on team, right? You know, if I put 99 investors on an interview, they'd all have a team in the top 3, but they, you know, some people say I want supply and demand. Some people, you know, we advocate for a triangle of 3 co-founders in a responsible matrix where one's a visionary, one's a technologist, and one's an order filler. You know, everybody's got a different matrix. Like, what's yours on team?
I think as a generalist investor, I think actually it's different strokes for different folks, and I think that there's a setting a specific mold for a team can be quite problematic. We all know that the team is the most important part. We all maybe don't all admit, and I'm willing to admit that experience comes into it quite a lot. It's all good and well investing into the 23-year-old visionary who's amazing, and don't get me wrong, most of the people that we invest into are either first-time founders or younger founders. But the reality is that we know this. We know the stats. The stats is that the people that are most likely to achieve outlier returns are people who have already had some form of exit previously, whether that's an outlier exit or not. Although if you had a previous outlier exit, i.e. exit for, let's say, over 500 million coming up, you know, or over $1 billion, you've got better access to capital, you've got better access to potential customers, you've got better access to basically everything that matters for an early stage company going through that VC journey. So obviously that's why you're more likely to do it. But even
you've got that resilience as well, right, Oli? You know, if you've done that level of exit or even a quarter of that, you're not worried about money day to day. So you're doing this with a very different sense of drive and purpose, right?
Yeah, that's a really interesting point that you've made there, and a point that I think garners quite a lot of debate in this space. And I actually had a conversation about this not that long ago. Do you prefer to invest into people who are already independently wealthy and successful, or people who aren't? And this has been a big topic of conversation, right? Because when I started in VC 9 years ago now, and this was before I was at Fuel, this was when I was at Syndicate Room in Cambridge. A lot of the conversation that I seem to be around people being like, no, we want people that are super hungry. We want people who failure is not an option. We want people who have like put it all on the line to make sure that this like business like works. And therefore the person to go for is the person who needs this to work, right? The person who's like, you know, who's not necessarily independently wealthy, but needs this to work for them to make riches, right? My view on that has changed over the years that I've been doing this. And the reason it's changed is purely through experience, some of the founders that I've worked with. And the conclusion I've come to is this: founders who are already independently wealthy, who have made their own wealth very specifically, are not quitters. So it's very easy to be like, well, it doesn't really matter for them because they've already been successful and they've already done, you know, they've already got money and things like that. Actually, I think that makes them more powerful for a couple of reasons. The first is these people don't quit, right? So if you're already someone who's built a very successful business, you are very unlikely just to take it on the chin that your current business isn't very good, isn't succeeding. Like you're a winner. Right, like you're the amount of resilience that you need in order to build a really successful company, you know, in the modern day, is significant, and you don't do that lightly, and you don't do that without a winner's attitude. So the idea that suddenly that you just be like, oh, I don't care about that anymore, is, in my experience, incredibly rare. Doesn't really pan out. The second is that people who already meet that first criteria and have done it successfully before, their previous success cements everything important in their life. And by what I mean by that is their kids are looked after, their families looked after, their house is paid off and safe, their kids are going to school. Like, all those important aspects of their life are already ticked off. They know that their family is happy and healthy and can succeed. And therefore, they can roll the dice just that little bit more. Because when you're not in that situation and you've got super important, the most important people in your life who are turning to you and expecting something from you, if things aren't working out, then actually that can be a drive to just be like, do you know what? I just need to go get a proper job, because I've got people that depend on me, and I can't let them down. It's the purest and realist reasoning in the world to say something like that, because, you know, you're absolutely right. You can never be in a situation where, like, you're letting your kids down and you're not putting food on the table and things like that, because ultimately you've got huge responsibility. And that, in my experience, can lead some people to stop rolling the dice, because actually what they need is security more than exponential growth. Yeah, and that's why my views changed a little bit.
It's super interesting when I teach on a master's course. When we talk about this in the founder team, I get them to walk along a metaphorical tightrope in the classroom. So, you know, some founders, they'll walk along a tightrope, they'll see the drop and they'll run across it anyway. Some founders will see the drop and fall because they choke on it, and some founders will see the drop, recognize they may very well die, and just say, screw it, I'm going to do it anyway. And it's interesting how many different founders there are. The ones that have got the kind of network that we're talking about here, they don't even see the drop anymore because there isn't an impact for them. It's kind of like, yeah, there's a high likelihood this is going to fail, but it doesn't matter to me, so I'm going to keep doing that tightrope walk because there just is no consequence almost. You know, it's a reputational thing maybe, but they'll go at it in a slightly different way. But when you ask, you know, which one would I invest in, I've got a cheese and wine palette for social mobility. So I'm always looking for that founder who's going to be creating their own future when they're going through things, and that's very important to me in the matrix. But I also recognize something you said there, which is the resilience of that high net worth founder is much higher, and staying in the game for 3 years at least on that venture is one of the keys to it succeeding. I know it seems really odd, right? But just to still be around 3 years after you started it is going to be quite special.
And to caveat what I said, Stuart, is, like I mentioned, the vast majority of people / businesses that we invest in won't meet that criteria, right? They won't be the independently wealthy person who has done really well and already and can roll that dice a little bit more, because those people are rare, right? Let's be honest, just statistically, those people are rare. So the vast majority of people that we invest into are those first-time founders. They are the people that need to make it work, you know. But it is something that we always take into consideration when we're doing our investments. Things like that. I run what I call a venture. I've got like what I call my venture playbook, which sits on my computer. Which I've got 8 rules in my venture playbook, which I always follow. Now, that rule about founder background and things, actually, that's not one of my rules. I've got other rules regarding founders, but that's not one of my rules. But it's just an observation that I've made after sort of 9 years.
Come on, you got to tell us, what are the 8? What are the 8?
Do you want me to read them out? I've got them up. I was looking at them this morning. Okay. So rule number 1, mediocre people with unique ideas don't work. If the idea is good, that person will quickly become a liability and the competitors will win.
Wow, that's number 1. That's a proper experience moment. That is okay.
And a lot of these come just from, a lot of these do come from experience, just in terms of like the people that we've invested in previously. And actually that goes back to what you asked earlier, which was like, well, what do I put value in terms of due diligence? Rule number 1, I will never, or I say we will never invest into a founder that we deem to be mediocre in the nicest way possible. Mediocre people aren't horrible people, right? But we just mean just from a founder perspective, just from an acceleration perspective. We will never invest into founders that we don't think can cut the mustard on the basis that we think their idea is good. Because those people in our experience, like I say, quickly become a liability, because actually if the idea is good, other people run with the idea and competitors beat you, which can be the most painful of all. When you've got a really good idea and a really good company, but actually you just can't make it work, that's one of the most painful situations.
I'm super keen to hear the other 7, but I so want to ask you this question. Like, do you have a personal way that when you're in the room with one of these founders, you know that they are going to excel? So, an example, I have this silly thing that I teach in my management development stuff, which is I know a really good salesperson when they're in the room, because I feel slightly uncomfortable around them because they're so far on along the spectrum from me, that a really good salesperson actually makes me feel a bit anxious. Do you have something silly like that you're using?
Kind of, and I for what it's worth, Stuart, I agree with you there. For me, quality of pitch is really important. The point where I know we're not getting through the IC process is when a pitch turns into a ramble. I say to a founder, well, tell me about yourself, tell me about what you're building, tell me about your background, and we're there for the next half an hour with the founder talking through pretty much all aspects of their business. That for me is a really low quality pitch. That is completely subjective, right? That is a subjective thing that's come around in terms of after doing hundreds and hundreds and hundreds of pitch meetings, that I can instinctively tell the difference between what I deem to be high quality and low quality pitch. But people that can't get to the point are problematic in that situation, because what I really like are people that are like, so this is who I am, this is my background, this is what I'm building, this is where we are right now. Bosh, 10 minutes. We've covered all the core bases, what you need. Great, I can ask you questions about the business now.
Nice. Go on then, hit us with the other 7. I love it. These are amazing.
Number 2, reference. When making founder-led investment decisions, make sure you're backing up assumptions with reference calls to mutual contacts and previous investors. Mistakes are mandatory for startup founders, but founders with a history of bad behavior will repeat it. And
sounds
again,
like good dating advice, let alone good investment advice. Right?
It goes back to I've had calls with people before. I thought, okay, this is quite an interesting founder, quite an interesting background. I've called their previous investors, and they've just gone, something happened, and we're not sure what happened, but we don't like what happened. And in that case, bad behavior generally gets repeated, in my experience. And especially under pressure. And the one thing you can guarantee about startup life is there's always going to be pressure. At some point, it's never going to go flying swimmingly all the time. At some point, there's going to be pressure. And that's where bad behavior comes out. So that's something that we always take into account as well. Point number 3, if a founder is not 100% engrossed within their business, they may as well be 0%. No distractions, no side hustles, no other roles, missionaries, not mercenaries. Again, comes from an experience in terms of investments that we've made previously, and something that we take into account. The thing that I'll say about all of these rules is that they are dedicated towards VC founders, not dedicated towards other founders. There are people out there that have fantastic businesses, that might have multiple fantastic businesses. There are people out there that aren't trying to build a £1 billion behemoth. They're trying to build a business that does 5 million a year in revenue. Great. These rules don't necessarily apply to you, because you're outside of our remit of what we would do. You've built a great business, but it's not quite the remit of what we look for.
Yeah, if you're putting 1.5-2 million into a seed investment, you're looking for a very significant growth.
Absolutely. We're looking for that outlier growth and outlier timeframes. Not every business can do that. Not every business wants to do that. Most businesses don't. That doesn't make it a bad business. It just makes it not suitable for us. There are plenty of fantastic businesses out there worth 10, 50, 100 million quid. Fantastic businesses, generational wealth for the people that start them, but just not the right business for VC necessarily. And so different set of rules, different strokes, different folks, right? Rule number, what am I on now? Rule number 4. Yeah, invest in products, not features. Do people expect what you're offering as part of other products that they use? Rule number 5, focused, intense execution is essential. Floating around multiple iterations of the product early on suggests that what you're investing in is not big enough. Rule number 6, the power law is essential. If the company can't be £1 billion in value, we don't do it. VC success is grand slams, not home runs. Sorry, that's rule number 7, discipline is easy to preach, but hard to teach. Whilst we know that basic metrics like CAC and payback periods are likely to have wild swings between seed and Series A, working with founders who understand what great looks like and try to manage them within their business early on means that we can manage outsized investment into those areas post-round. A founder who says we'll sort that out later has no evidence that it's possible.
And do you find in your portfolio that you end up following that kind of power law thing where the ones that are excelling, you double down on, and the ones that are dropping off, you're basically giving less attention to?
Yes. As a rule of survival, that's what we have to do. And don't get me wrong, it doesn't get to a point where we're just like, well, you're cut off. Like there's no founders in our portfolio who I think would openly admit that they haven't achieved what they wanted to achieve. I think there is room, especially with like smaller VCs like us, seed VCs, there is room for these smaller success stories, right? Because in a world where we invest into a business at a 5 million pre, hypothetically, and that business never gets to these outlier returns that we want, but manages to sell for 30 million at some point 5 or 6 years down the line, right? It's not the outlier that we want, but it still has the potential to return good money to investors. And actually, when we're thinking about building a portfolio, actually, if we end up with, in a portfolio of 15 companies, if we end up with a couple of those businesses, if three of those businesses return either the money that we originally invested or maybe a couple of X on the money that we originally invested, they're not outlier, but they've actually grown significantly enough that actually they can return good money back to investors. Then meeting that threshold of, okay, great, now we're making money for investors becomes easier. And hopefully within there, you've got that grand slam opportunity that is really shooting the lights out. But it doesn't mean there's no room for supporting those slightly smaller companies that haven't quite hit the remit of what you want. And then my last rule, move fast and break things is always the goal, but it doesn't work in all areas, such as health, politics, and cybersecurity.
Fair enough.
Yeah. And that's to remind us that there are industries out there that require outlier investment earlier on, because the strength of their product is so core to any revenue coming in. You can't be a cybersecurity business with half a product. Because you can be a SaaS business with half a product. You can be a B2B SaaS business where you're like, so this is what we've built. It does one core thing. And actually what we're going to do is we're going to build out on that. You can't do that with a cybersecurity business, because if cybersecurity fails, there are massive, massive, massive internal repercussions.
I think there are people at M&S and the Co-op and a few other places recently that'll probably agree with you there.
You'll probably agree with that, absolutely. So yeah, that's my list.
Okay, no, that's fantastic. And you say, I mean, did you come up with that stuff before you met with the market and all the different interviews and things you've done, or are they all from experience? Just kind of like heuristics built on the good, bad, and ugly that you've...
They are pretty much all from experience. These are, I mean, I still change this list. I add to it, I take away from it, I change it. Because I'm learning new things every day from the people that we're talking to. Yeah, this is from learned experience of doing. I've been at Fuel for over 6 years now. I've been involved in this industry for about 9 years. And this is just my learnings over the course of those 9 years.
So when you guys make an investment, do you personally then get involved with the board? Do you just have observation rights? Would you take a seat? How active do you get involved?
We just have observation rights. We used to take board seats, and then we realised that was not that responsible, to be totally honest. Last year, we changed the policy on that. We changed it for a couple of reasons. The first reason is because actually it can be quite difficult for the company. When the company wants to do things like open bank accounts or regulatory bits or anything like that, they need information on all the directors of that business, including us. So if we're a director, the company then relies on us to provide a quite significant amount of information, and obviously that's not our full time. Our job is to work with loads of companies, and so what we found is that we could sometimes hold the process up, and actually for companies that's not good. So we felt that within our agreement that our investors were suitably protected through the shares that they had, the shareholding that they had, and that observation rights were suitable, and so we moved to observation rights. On a more selfish aspect as well, like one of the things that we have to think about is how we manage our fund. And if businesses are not performing, we need to make sure that we're spending as much time as possible with businesses that are performing. And actually, if you're a director of a business, you can't do that. You've got fiduciary responsibilities on that business, and the shareholders and the creditors of that business that you need to fulfill, which can make the process of managing an entire portfolio quite difficult. Because actually, from a fiduciary standpoint, the time sink is going to come from the businesses that aren't performing that well generally, because that's where you have to be careful of things like solvency and stuff like that. Whereas in our head, we want to make sure that we focus more time on the businesses that are doing well, where we can support them even further. So it became, in my view, slightly counterintuitive to what we were trying to achieve as a VC. And actually, we felt our investors, like I said, were suitably protected by the observer rights that we had alongside the class of shares that we had in those businesses.
Nice. Well, this leads me to one of our sort of traditional questions in these interviews, Oli. What makes you awesome at your role?
Absolutely nothing. My job is not to be. My job is to find the people much better than me. Frankly, is to go into a room, find the people that are much more skilled, much more talented, much more experienced than me, and convince them that we're the right person to support them. I think one thing that we do particularly well at Fuel is frankly a sense of humility. When we come to a business, we're not there to rip apart your company. We're not there to rip apart product. And I've seen VCs that come in and the first thing they want to do is they want to get knee deep in the product and they want to rip it apart and they want to talk about, we've got this technical expert that comes in and does this and does that. And I do ask myself the question sometimes, why are you investing into people where you don't really even trust the product to be a good product? I think one of the things that we do relatively well is a level of humility where we say, look, we're not going to get involved in that side of things. We're a seed investor. We're a generalist investor. Our job is not to come in, get knee deep in the product and absolutely rip it apart. Our job is to support you in all the periphery things that go into building a really fast scaling business. So we can help on things like HR policies. We can help on things like hiring. We can help on things like future fundraising. We can help on things like setting up options pools and option schemes, things like that, giving views on that. I'm not here to change the core of what your business is, because if I needed to change the core of what your business was, then I'm not really sure why I'm necessarily invested into it directly. Like, I'm here to support you so that you can spend more time doing that, because I think you're really talented individuals and that you've got the ability to do something really great. And I'm here just to release some of the stuff around the outside, help you with some of that, so you spend less time doing that and more time with the business.
And that's the sort of stuff where, having done this multiple times before, you can simplify, almost commoditize some of it, right, and make it easy, rather than first-time founders. It's going to drag them back, and they're going to spend all this time on options pools and not so much time with customers, right?
Absolutely. And I'm a big fan of things like founder-led sales and things like that. So freeing up as much, especially between seed and Series A, so freeing up as much time for the founders as we can, so that they can really dive into the core important parts of the business, as opposed to, like you said, doing things like options pools, which are important but shouldn't suck up huge amounts of founder time. Then I've done my job. And I think there is a level of humility there that we do quite well at. Like I think we bring the help when the help is needed. I think we back off when we should be backing off. I think we're quite active and we're quite good at that. But beyond that, Stuart, like our job is not to be remarkable. Our job is to back people who we think are remarkable. And within that, like, we have to accept that we need to let these people fly, breathe, We need to give them space. We can't constrain them within what we think building a business is. We can just support them. And I think the thing, if I was going to be self-congratulating, a pat on the back, and I think that one of the things that maybe I do well, and I think we do well as a group, is getting into that room, getting in front of the people who really are talented human beings, more talented than we are, and saying, look, we think that we'd be a really good partner for you, and this is why. And them going, okay, great, yeah, no, I agree. I think you guys would be a really good partner. So I want to take your money, and I want you to be part of this experience. I want you to be part of this journey, and supporting them through that.
That's super awesome, Oli. And I didn't think that's what you're going to say either. It's really interesting. Thank you so much. I've enjoyed every aspect, especially the 8 rules today. I guess it sort of falls to me to ask you the final question, which is, what's your best advice for a first-time founder? They're looking for money for the first time. They've never raised an SEIS or anything else before. What's your best guidance for them?
So the first thing I would say is know what you're trying to achieve, because it's going to have a huge effect in terms of who you should be speaking to, which in turn can save you a lot of time. One of the things that we get approached by, and I alluded to this earlier, I talked a bit about this earlier, we get approached by a lot of founders who are just not VCable. A lot of founders who are just not VCable. They're not bad founders. They're not running bad companies. They're just not VCable. And there is a distinct difference between something that could be supported by VCs and something that could be supported by angels, for example. And angel investors are a fantastic, completely legitimate route to raising money, but the return profile for an angel investor or a VC investor can be very, very different, because VCs have to work on a portfolio basis and angels are working on an individual basis. You know, all the money is their money, they make all of their decisions, and a return on an individual check for them is positive, whereas for a VC, not necessarily. So you need to know what you're looking for. And actually, you need to know that what most institutional investors are looking for are these power law style returns, where we can take this business to 50, 100 million plus in annual revenue. It's a very specific path, and it requires you to be comfortable with 4 years of burning capital in order to get that outlier growth. Don't get me wrong, there are stories out there about people who are always profitable and they're very rare. Burning capital is the norm. That's why you're raising money. But you need to be comfortable with that. And if you're either not comfortable with that, or you're not convinced that in that time frame you're building a business that does 100 million in annual revenue, VC is probably not the path for you. So don't try and structure yourself like it is. Don't be like, I'm putting together a pitch deck and going out to VCs. If that's not the path, that's not the path. It's not a point of shame. It's not a point of bad business. It's just different. And so save yourself the time. So my advice to it, just to condense it, is before you even go into this process, know who it is that you want to speak to and why you want to speak to them. Save yourself the time, save yourself the effort of getting 2 months into the process and being told by 50 people that you're not a VC-able business.
Thank you, Oli. It's been a real gift to the community today. Thank you so much for this knowledge share. Really appreciate it. Is there any last question you want to ask me before we go?
Yeah, go on, Stuart. I'll ask you. So you obviously work with a huge number of founders. Based on the advice that I've just given, do you think that all of the founders that you work with are VC founders, or do you think that actually most of them, even if most of them, are actually not VC founders, and that's a conversation you've had to have?
If you just asked me which one is my favorite child, that seems pretty harsh, right? You know, if there was a burning building and all the founders are in it, which one am I going to rescue? But no, I completely agree with you that in part of our guidance and the fundraising stuff and the prep that we do, and even on the master's course, is saying pick the investment route that's right for you, that models with the profiles that you're looking for. And a lot of the times, the biggest, we run a mini accelerator program just before Web Summit, just for London Tech Week, where in one day we help people work out how to speak to investors when they're in the conference. And the biggest single piece of value that everybody always feeds back is I sit there and I explain to them the difference between how an angel thinks versus how a VC thinks versus how a corporate venturer will think, and how an SEIS fund like SFC might think compared to even Hatch VC or Fuel. And when we go through that spectrum of different needs, and even down to the simple thing like, try not to say this too glibly, but an angel is worried that you're going to lose their money. A VC is worried that you can't grow fast enough, and an SFC equivalent fund is worried that they can't get the money to you fast enough, because they've all got different needs, and they've all got different expectations. And then an SFC might wait for 10 years and see what happens, and they've just observed from the periphery all the way through. An angel is worried every minute of every day that you're going to lose their money, and they're not going to make a positive return on that, and it's going to be less than 5% of their net worth that's gone into it. But if they've overextended, they're going to really feel that if that goes wrong. They're not managing a portfolio, as you say.
Yeah.
And a corporate venture is usually trying to acquire some sort of solution to a problem that they've got within their corporate environment. And most founders, when they hear that for the first time, and particularly when they hear what a decent VC is doing in terms of fund development and moving through from 50 to 250 to 500 million type funds, they completely change how they walk into the room, and they're almost pre-screening now. Okay, which one are you? Are you the ones that I need to meet? Do I have to up my game, down my game, change my numbers? And they stop giving one deck to everybody. They start thinking, okay, you've got very specific needs. I need to give you a different deck to this other guy who I need to give a very extreme example of a deck, and maybe I don't want that. But it's amazing how that isn't understood, particularly in first-time founders. And of course, where is it taught? It's not like there's a special school for founders. Even masters in entrepreneurship don't always cover this, and so the masters I taught on didn't cover it before I went and involved myself with that curriculum and added these kind of elements in.
Yeah, absolutely, totally agree. I mean, listen, mate, it just sounds like we're on the same page, isn't it, right?
We've obviously kissed the same frogs or gone through some of the same pain. But thank you so much. I mean, the whole goal of these interviews is about empathy. It's about empathy between founders and investors. And I think what you've shared today is such an incredibly valuable share that anybody watching this will now have a much clearer understanding. When should they come to Fuel? Why should they come to Fuel? And when should they not do that, right? Because they're just not the right fit. So thank you so much. It's a real gift. Thank you.
No problem at all. Thanks, Stuart. Really appreciate the time.